Hi guys! In this video, I'm going over Chapter 8, which is rental properties, royalties, and income from flow-through entities. So income from flow-through entities is income from certain types of businesses, such as a partnership is a flow-through, LLC is a flow-through, it doesn't have a tax form, but um, an S corp is a flow-through entity. A corporation is not. So you really learn about these flow-throughs in business tax, which if you're watching this video in individual tax, you'll learn more about flow-through entities in business tax. If you're in business tax and you're watching this video, you already have a background of this. I'm going to be having both of my classes use this video for rental properties since I know it wasn't covered in last year's individual tax. But I think that this is a good thing for us to cover because rental properties are just very common. So is the concept of passive income. It's just something that tends to be important to people who want to learn about accounting and taxes in business. This topic itself seems to be very important. So that's why I wanted to cover this in both classes. So all of these things are reported on Schedule E. And Schedule E, of course, is an individual form. That's why it said Schedule E Form 1040. You see it right here. Schedule E Form 1040, because this Schedule E is related to the individual form. So anyone who has rental income, partnership, S corp, estate, trust, remix, special types of organized passive income companies. So here in part one, you can see income or loss from rental real estate and royalties. So essentially, rental income, as the book describes it, is when you're renting real estate, office buildings, rental houses, condominiums, or townhouses and vacation homes. Taxpayers report gross income, rents received, and then ordinary and necessary expenses are deducted from that amount. The net income, so then you have your expenses down here. This is essentially, part one is where you list the property. Then down here in line 1B and line 2, this talks about fair rental days and personal use days, because you don't get to deduct any expenses on a rental property for days when you personally use the property. There's also special rules depending on how many days you rented the property out. And just to back up a second, a rental activity is this special, they use the term, as they say here, for the production of income. And this term means it relates to activities that are not trade or business, but are activities with a profit motive, rental property being the most common example. So there is a profit motive, so that's why we can deduct most ordinary and necessary expenses. And now they're going to talk about the most common types of activities of production of income. So essentially, a rental activity can be considered a passive activity in some senses. It can also be considered, there's some other thresholds, and many of the rules have changed this year as far as special deductions that allowed people to deduct a loss from a rental property. Because of course you're getting equity in that building. And when you sell the building, it becomes what is covered in Chapter 7, capital gain or loss, right? Because it's a capital asset as something held for investment purposes. So there were changes as a result of the recent Tax Cuts and Jobs Act. Income tax rates and applicable taxable income ranges, so those changed. Obviously, that impacts the taxability. This 20% of income deduction on flow-throughs it's kind of a general side of things. There actually were a lot more changes based on depreciation of the building or real estate itself, but those rules do get rather complex, and we probably will not be going into those in the chapter. So let's see. This was the section I just read through. One thing I wanted to tell you, especially for my individual tax class, Schedule C is very similar to Schedule E, but the difference is that Schedule C is for self-employed businesses. And so we will not be covering Schedule C. You'll be learning about Schedule C in business income tax. If you decide to take business income tax, we'll start out Schedule C and then cover all of the other types of businesses. But self-employed businesses are the only businesses that are reported with the owner's personal tax return on a Schedule E, and it's the same concept. You report your income, you report the expenses, and then the net income goes to Form 1040 for the individual return for tax. So not your total income, right? Not the total income amount. It's after all of the expenses. Income minus expenses equals the amount that goes to be taxed for your income taxes. And of course, there are many expenses down here that have very special rules, such as depreciation, which is the deduction you get to take for the cost of the asset, such as the real estate in terms of a rental. And if you've already watched the Chapter 7 video, which most people should have, then you already got a feel for what happens when you sell an asset, right? You have this investment in the assets, which is called our cost basis. So sale price minus cost basis equals any gain or loss on the sale of that asset. So rental expenses. So they talk about the criteria for a business, Chapter 6 expense, which just means that it's ordinary and necessary, and that's a similar threshold for rental properties as well. It doesn't have to be a required expense, but it does have to be an ordinary expense that makes sense and related to the activity directly, which essentially means that you can't have personal nature in what you deduct. And that's why we have to allocate out any personal days. And if you only rent the business for a small number of days, you don't get to take some more advantageous deductions that you do when you're actually renting it out for the majority of the year. So that way people don't go, okay, I rent my house for a week. Now I get to write off all my expenses, right? So the rules are stricter the less time that the house is available for rent. So we're going to look at some of the examples here. Jack is a real estate professional who owns and operates a bed and breakfast in North Carolina mountains. Jack provides significant services to the renters and has no other trade or business. As such, the activity is treated as a trade or business, not a rental property. And therefore, he reports it on Schedule C, not Schedule E. Now, a main criteria of this is that he had no other trade or business. If he had a full-time trade or business, he would be able to provide some services to the people renting and staying in his house, but it wouldn't have met the threshold of a full-time business. But since he has no other business, this is obviously sustaining him, and he's putting most of his time and energy into it. And so it's no longer treated as a rental property, and it's treated as a business. Now, the big difference here is that on Schedule C, you pay self-employment taxes, which is Medicare and Social Security tax. They're called self-employment taxes, but every worker pays them. However, rental income is not subject to those self-employment taxes because it's not actually a business. One other thing to point out is that a business that develops real estate, that say builds houses and sells houses, though that means that that's not rental activity, right? Because that's not a passive investment. That's what they're in the business of doing, which is a crucial criteria for business activities. Farm rental, farms have very specific rules to give them a little more flexibility because we like to support our farms. On December 12th, here's our example 8-2. On December 12th, 2018, Delia received $7,000 from Philip to cover 6 months of rent from December 15th to June 15th, 2019. The payment includes a security deposit. So because security deposits are not considered income, because you have to give it back. So you would only record a security deposit as income when you actually earn it and need to spend it on improving the property. Then it would be income and an expense at the same time. Otherwise, landlords are required to hold a security deposit in a separate bank account so that it's available in case it's needed to either give back to the tenant or repair the property. So then the next issue would be that December 15th, right, was only in 2018, and then the next year. So does he have to report all of this income in 2018? If he got it up front like this, yes, he does have to report it all in 2018, since he's most likely a cash basis business owner. And if he received it up front, regardless of if they're cash or accrual, would have to record it in that situation. Now, let's say a tenant pays expenses or services, provides services in exchange for rent. The landlord still includes that in rental as rental income, which a lot of people don't think about. Example 8-3. Bill is the owner of a house that rents for $900 per month. During the winter, while Bill was on vacation, the furnace failed. The tenants of the house had the furnace repaired and paid $300 in repair costs. On the first day of the following month, the tenants reduced the rent payment by $300, paying just $600. Bill is required to include how much as rental income? The full amount, right? But he can deduct the repair expense as well. Okay, Bill owns a second rental house in need of repairs. He allows a new tenant, a carpenter, to live rent-free for 3 months, which was a value of $1,800. In exchange, the tenant will complete the necessary repairs. So, of course, same thing. Bill includes that amount. However, he also gets to take a deduction. Now you see that this says assuming that they are not capital improvements. We'll talk about that in a second. We won't go deep into that, but there is a difference between repairs and maintenance and having to record something as capital improvements. Let's keep going here. So here we have an expense, common rental expenses, and the purpose. So I would recommend reading through these. Repair and maintenance costs is normal repair and maintenance costs that are not capital improvements. So what are capital improvements? Capital improvements significantly improve the asset. So specifically with a house, the difference between repair and maintenance costs, if you fix the roof, that's repair and maintenance. If you have a new and better roof put on the house, that would be a capital improvement. Now, the difference is that repair and maintenance costs are expenses, which are 100% deductible. Alternatively, capital improvements are just like when you buy the house, you have a basis in that as an asset. You have to capitalize that asset. You don't get to deduct it all at once, and you get to spread the investment cost out over time to match that expense with the income that the asset will produce. So we do that through depreciation with the house and with assets like capital improvements as well. And there are specific rules, which you'll learn in business tax, income tax, if you decide to take it, in which those of you in business income tax have already learned. So with rental properties in particular, if it is in a residential area, the house is depreciated over 27.5 years, according to this method. If it's commercial, it's over 39 years, according to this method. They all use Maker's straight line method. And as it says here, any expense that is necessary is really deductible. It's not so much limited to that. We'll do one more example here. Brian lives in Birmingham, Alabama, and owns a rental condo on the beach in Destin, Florida. Twice a year in March and June, he drives to Destin to perform general maintenance on the condo. The round trip mileage from Birmingham to Destin is 602 miles. In 2018, now we're going to calculate the cost of travel that he can deduct for maintaining his condo. So he'll take 602 miles times 2 trips times 54.5 cents per mile. And that's the same mile that self-employed business owners get to take for mileage that they drive with a personal use vehicle. Because this is going to be a personal use vehicle as well that he's just using for the rental property. And so the taxes give a special exception to be able to take a deduction for this cost. It's based on timesing. This is the easier method. There is the actual expense method, but it's typically not worth using. I highly recommend just using the standard mileage rate. You can see that gave him a pretty decent deduction of $656. Okay. I already covered that about this is going into the capital improvements. And this talks more about that. Now, they did make some changes in regards to this. Starting in 2014, certain small rentals can elect to deduct certain improvements as expenses up to a maximum amount of 2% of the building's unadjusted basis. So essentially what the building costs, the cost basis, or $10,000. Now, these rules have gotten even more extensive and allowed for much larger amounts. It doesn't seem as though we get into those details in this book because these rules are quite extensive. And you can see these are the depreciation rules for other types of assets. So we'll do a bit of depreciation review here. Alan and Sherry Masters purchased a furnished beach house in California for $1.3 million. And on June 1st, 2018, the land was valued at $700,000. Furniture, $15,000, appliances, $3,000, carpet, $4,000, and landscaping, $8,000. The masters rent the house full-time, no personal use. If the masters depreciated the house as a single sum, as 27.5-year property, which is residential property, their first year depreciation would be what? So if they bought the house with all of that stuff included, the way depreciation works is we just use these tables. So general depreciation system, straight line, applicable recovery period, 27.5 years, mid-month convention. And, oh, we moved our page. So all we are going to do is look at what the recovery year is and the month we are in, and we take that amount as a percentage and times it by the basis. Oh, it's not going to take me back. So that would be this 1.97% times 664,000 equals $13,081. On the other hand, if they divide the assets based on the type of asset that's listed here, they can do out the depreciation. And because most of those assets have a shorter year life, it's going to result in a greater total depreciation number, which they have the right to do. They can allocate the purchase price to other elements that they purchased. Okay, so here's a bigger problem, shoebox to software, where they're going to go through a problem and then update the Schedule E based on the income and expenses. And then this is the depreciation form. If you're an individual, you will not be doing any depreciation forms. Let's see. Vacation houses do have more rules, like I mentioned already. So if the house is used for less than 14 days, if it's rented for less than 14 days, then you actually do not categorize it as a rental. If or 10% of the total days rented, if more, for personal use. It is not used for more than 14 days for personal use, and it is rented for more than 15 days. So that means that's the beginning threshold that it starts to qualify for rental. The category determines how much of the rent. So you can go through these criteria. Essentially, what this is all summarizing is that if the property is rented for less than 14 days, it doesn't have to be treated as a rental, and the income isn't reported and expenses aren't deducted. So here's an example. John owns a cabin in the mountains. If he rents the cabins for the ski season, 4 months, and uses the property for personal use for 13 days, the cabin would be categorized as primarily rental property. If John used the property for personal use for 21 days, the property would be categorized as personal/rental. If John rented the cabin for less than 15 days, 14 days or less, the cabin would be categorized as primarily personal. So personal use of any dwelling unit is any use by the taxpayer, members of his family, or anyone that has an interest in the owner. Example 8-8, Nick owns a rental beach house. Him and his 2 daughters spend 2 days at the beach house where Nick repairs the deck and the screened porch while his daughters relax on the beach. The 2 days are not considered personal use days as long as the owner is making some sort of improvement on the property. Okay, so we're going to, there's some last little concepts you can read through. There are a difference in allocating the expenses by days in the year, which is what these 2 methods go through here. It's really interesting. So essentially, tax court method, that means based on the rules that the tax court has determined, the amounts between these 2 methods can be very small. So as far as it being, certain softwares just use the IRS method, which is just the favored method, although the tax court has declared the tax court method has ruled in favor of it. So royalty income is also considered this same type of income as rental property, where it's for the interest of earning income, but it's not a business because the owner doesn't work in that business, have a material interest working in that business. So here you can see royalties in box 2 of, this is a 1099 miscellaneous. So non-employee compensation goes in box 7. This is the one a lot of people get paid as an independent contractor these days. This is the form they receive. You can see it also reports rents in box 1. So if a business is renting a property, then they report the rent that they paid to the owner of the property using this form. And that's because they're going to take that expense as a deduction on their return. So you always only have to file this if you're a business wanting to deduct the amount that you paid on this form. Okay, so one of the biggest examples of royalty income is a book and making money off the sales of the book. It also is related to production of like oil and other precious metals and things of that nature that are mined or whatever for the owners who invest in the property to do that type of extraction and then make money in the long term. So here's our example of royalty income. Shay is the author of a best-selling book of poetry for which he receives royalties. He also presents seminars and readings of his book of poetry through the country. Shay's payments for the readings and seminars are not royalties. That's an actual business. He reports his income from the readings and seminars on Schedule C and the royalties on Schedule E. So both of those payments are considered separately. John is a full-time author of mystery novels. He has an office in his house and no other source of income. The royalties John receives from his novels are trade or business income and reported on Schedule C. Here's another example. Lily is a business executive with a large import-export company. She owns some land in South Texas. Recently, a small oil reserve was discovered on her land, and she began receiving royalties for the oil produced. Lily reports these royalties on Schedule E because owning the land is not a trade or business, but an investment. Another company is extracting the oil, but paying her royalties for using the land and taking the oil off of it. Okay, so that is all for this chapter. I'll briefly mention flow-through entities here. LLCs are the most common, partnerships, S-corps, certain types of trusts, all file what is called a Schedule K-1. So essentially the way these business forms work is they have a main form which goes over the business income and expenses. If the business has investments and other types of activities, those all flow through, and so does the net income from the business and anything that can be handled based on the amounts that the individuals have on their returns. So the thresholds and limitations and calculations are calculated on the personal owner's returns because the activity from the business flows through on a Schedule K. The owner reports a Schedule K1 with their portion of the activity flowing through. Now, all of these types of business qualify for the new qualified business income deduction of 20% of income, which is really a massive deduction and really goes against the standard concept of deducting expenses, i.e. cost of earning income. This instead is a deduction based on the amount of income, which is a very different concept. It's quite a complicated deduction, even though it sounds simple. So this is a Schedule K1, which you'll learn about if you're taking business income tax, and you should already be familiar with if you've taking business income tax right now. Passive activities, a partnership, as someone who's just an owner in a partnership, can be considered a passive activity if they don't work in the business. And so if they don't work in the business and they don't pay self-employment taxes, remember, self-employment taxes are the same thing as employee taxes that you pay as an employee. So they're not any different than employee taxes or Social Security and Medicare. But it decreases the amount of tax that have to be paid to encourage people to invest in passive activities that do not require them to essentially work to earn income. Okay, that's all for Chapter 8. Post questions in the forum. There's a forum set up for both of these chapters this week. And I will see you in the next video. Bye, guys.